some of you know me, I guess, and some of you don't. For those of you who don't know me, I often work layers sort of 2 or 3 up to 7 and focus on vulnerabilities and defending systems and very, very technical work. But I was lucky enough to attend Cambridge for my master's, and they do a lot of work in security economics. And recently I got invited to be part of a new center, the Center for Risk Studies, and to do some new things. So this is not a talk about vulnerabilities and hacking. It's more of a talk about defending critical infrastructures, mapping critical infrastructures, and moving things towards a science of criticality. It's not going to be easy to talk about. It's difficult to get you to shift your mind from all of the things you've just heard. You've heard about real events that are going on in the world. I'm going to talk about the power of imaginary events for a lot of this talk. We invent disasters. Essentially, I invent role-playing games for disaster executives. That's what I do at the center. And that's really exciting, and it has a power that most people would not expect, which is that a lot of the work that we do is under NDA. We can't talk about the things we've found in critical infrastructure, right? So by making up a scenario, we have something to talk about. So normally I wouldn't do any sort of sales pitch or anything and introduce you to my organization, but I want to, and you'll understand a little bit more about why I want to do that towards the end. So no sales pitch on a product. We're a partner organization. We're not selling anything. But these are some of our partners, and what they do is they come to us and they ask us to invent disaster scenarios for them. Now, we don't just do technology. We do war, terrorism, kidnapping, pandemic, solar storms. We cover a wide variety of different threats, and we'll talk about some of those in a bit. But what's the bit that ties everything together? And the answer is basically economics, macroeconomics, and network theory, network science. And so all of the people who work in the center have to be able to speak to each other about networks and network science and macroeconomics. So this is the taxonomy of threats that they created at the center before I joined. You'll see that they are a bunch of cats, which I find sort of funny. So we sometimes refer to each other in the center as, hey, that's eco-cat. Hey, there's tech-cat. Here's hate-cat, right? And these are, I think of these as like the 12 disciples of risk, who work at the center. And you'll see that down at the bottom, we left ourselves space for risks that we didn't understand yet, the externalities. Exogenous events that we've never experienced before. And I'm not just responsible for cyber attacks, I'm also looking into technological disasters of other types. But the key to that is, why macroeconomics? Why would you go from being a hacker to going and learning some macroeconomics? And one answer is because I can, and I enjoy learning new things. But the other answer is because it matters. When you try and do critical infrastructure protection or facility protection, you're always tasked with saving the company some imaginary money that they would lose because of an event. At a company level, they might have some sense of that. When you stop baking this many cookies, this many times per hour, you lose this much money. But how do you do that at the nation level? How do you study that in terms of GDP? All right, so we have done these stress test scenarios over the last year. You can go to the website and download them if you are interested. Who are the primary funders that I'm working with? Reinsurers. So these are the people who insure insurance companies. And they are interested in protecting the US power grid. But they have to have the right amount of money in the bank. So we have to invent these stress test scenarios for them to test out different assumptions, right? So the one we created recently is the Sybil logic bomb. And I'll save you all a lot of time because you're very technical people. Essentially, the Sybil logic bomb is an insider attack where an algorithm is corrupted, and it's based off of Oracle. We don't want to use Oracle because they're a real company. So we have this fictional company called Sybil, and they have a market share similar to Oracle, and we explore the macroeconomic costs of that kind of flaw in a system. From a technical point of view, it will bore you, right? It's not about that. It's about reading the impact systemically and assuming that there is a knock-on impact of any particular virus or attack onto other companies in the world or other nations, right? And if that impacts the economy, it ripples all the way through to many different countries at the same time. So that's what we do with these stress tests. If you're interested in them, go ahead and read them. I certainly enjoy reading some of the other ones. One of my colleagues is doing geopolitical conflict and social unrest at the moment, and I find that fascinating. The mathematics and the network theory of pandemics, also fascinating. So enough on the sales stuff. These are the kind of force-directed graphs we produce, and you can see that they are network models, right? we get a sense of the magnitude and the weighting of the relationships of these different incidents. So we build some sort of a model of, say, air traffic in the case of pandemic, or in the case of market share of our fictional Sybil Oracle-like company. And this means that we can do cascade failure studies, and we really enjoy it. If you're a little bit more flippant, this is graph porn, but it's meaningful for the real world. Okay, so if you are critical infrastructure protectors anywhere in the world, what's your wish list? Now, has anyone read Rinaldi's paper from 2001? Please, someone? No? I know you two have, at least. Okay, well, this paper was by Rinaldi and a few other people, and essentially, it was a framework for thinking about the interdependency of critical infrastructure. All of us have anecdotes when the power goes out, 48 hours later, telecoms fail because the batteries have run out of juice for all of the cell phone towers. Every one of us has a story like that about Blackstart or whatever, and we love to swap these stories. But what we don't really want to do is have to swap those stories forever and not move towards a science. So what if we could extract this information about this interdependency without having to just repeat anecdotes, without having to wait for a failure to occur, to study it, to find out what was interrelated? Now, of course, I can't do that exactly. That's the dream, right? But can we approximate a little bit of that in this particular talk? And I think my colleague, Dr. Kelly, has done some amazing work on that. So he suggested that we look at the economics of this system. These sectors buy goods and services from each other, and that data is published, and you can acquire it, and you can study it, and you can get a sense of how much the water sector purchases from the electricity sector. We also have this traditional notion of these 13 critical infrastructure sectors. Well, I want to challenge some of that thinking and get you thinking, are these all critical? Are they as critical as I think they are? What about the science of criticality? What does criticality mean? Are we talking about economically critical? Is it the most important thing to our GDP? Is that the most important thing? Or is it saving lives when sanitation goes down? Some of these things mean we'll have to talk about criticality in a much more broad and creative way than just saying it's critical. So can we get towards the science of how it's critical? Is it economically critical? Is it physically interdependent? Is it logically interdependent? And I suggest you go and read this paper. So this is what we came up with for the UK. I am looking at more than one country at the same time, but this is the economic infrastructure network. So this is the amount of goods and services exchanged between UK sectors. And your traditional critical infrastructure is colored in red to make it a little bit easier for you. But you can see that the volume of money traded by these other groups is pretty high and not in sync with our theories on critical infrastructure. A little bit later, I'm going to talk about how we measure the cost of outages, whether they be electrical outages or anything. But for the meantime, let's just say that this is a very loose map of the interrelationship of the infrastructures in the UK, whether they're critical or not. Okay, so let's just adapt this a little bit to make it easier to read. So this is relationships between sectors greater than 1 billion. Now, I certainly wasn't comfortable talking about these kinds of numbers in terms of pounds or money until I got to the center and met some of these people. One of the advantages of being in Cambridge is the history that's present and the people who have accomplished things. And when you're dealing with insurance companies who take 1 in 1,000 year risks to reinsure other insurance companies and have been in existence for 350 years, their approach to these problems is very different. They're very comfortable with the idea that they don't understand it right now, but they will in the future. So let's take another examination of this graph. By removing all of your critical infrastructure, your non-critical infrastructure as we would describe it, and just look at the traditional model of the relationship between critical infrastructure. Unsurprisingly, there's a strong correlation between gas and electricity, and you can see that land transport is pretty important as well. So I'm excited about this because this is towards a science of criticality, at least the economic level, right? It doesn't necessarily capture public health or logical interdependencies of these different groups, but you know that they're dependent on each other in some way. And one of the other things that I think is exciting is that this is different for every country. Countries that don't have regular electric power have a perceived reliability. That's how we describe it in the literature. And that perceived reliability is lower. They expect a power outage every day. These people are not, their economies are not dependent on electricity being provided all of the time. How do we capture that in a sort of mathematical sense when we're studying other countries, right? Basically, what I'm saying here is developed nations are more reliant on their infrastructure than other countries, and other countries rely on different infrastructures than we do. So being able to draw these maps and understand these relationships pushes us towards a science of critical infrastructure mapping, dependency, and understanding. So is anyone here familiar with WTA and WTP? This is economic stuff. I had to I had to learn from scratch very quickly a bunch of macroeconomics. So willingness to pay and willingness to accept. Has anyone encountered this before? These are survey-based methods. This is essentially macroeconomics' relatively cutting-edge way to understand how much people would pay to have more reliable electricity than they do currently. And we call that willingness to pay, as in they are willing to pay to have an outage at this time. This is the core of smart grid thinking, right? You also have willingness to accept. Willingness to accept the outage and willingness to pay not to receive the outage. And strangely, well, not strangely if you think about it, willingness to accept is usually a higher amount of money than willingness to pay. So I expect you to pay me more money to turn my electricity off than I would normally pay to receive it. And that's because our perceived reliability is so high. So I'm tasked with creating a fictional outage in the US as a result of a cyber attack so we can all talk more freely about these things in the future. And they say to me, what's your cost function at the end? How much is it going to cost, right? If we can't figure out how much it's going to cost us as a nation when the power goes out, we can't really figure out how much we're going to spend protecting it. And I find that frustrating. I wish it wasn't survey-based, but it is, okay? So they run these surveys and they ask people, and I think one of the problems with these surveys is they usually don't divide up residential, commercial, and industrial customers who will pay different amounts. And the reason we like to survey is because we can average some of those differences. Some types of customers really care when the power goes out, some don't. Some have a lot of stored supply. But the basic idea is that they run these surveys. So we chose not to use value of lost load because it didn't include, it does include residential, industrial, and commercial customers, but it was done in pounds. So the survey was done in the UK, and I'm tasked with creating a US outage. The other thing that I don't like about these things is it's linear. And your cost functions truly are not linear. But we're modeling here, and we're willing to accept some amount of error. What do I mean when I say they're not linear? First 4 hours of a power outage, you might not care so much. You didn't get some work done, but it doesn't matter. 24 hours, 48 hours later, your food is spoiling. And suddenly, from an insurance perspective, you've got these peaks and troughs of the amount of cost. If power is still out for an exceptionally long time, like the Iggland case that Dale referred me to and asked me to look into, it's a famous outage. You can go and look it up as well. But it's interesting because it happened in the center of some city blocks, right? So these 5 or 6 city blocks in Auckland are off supply when everybody else next door is on supply. That's important because you think to yourself, oh, I'll just move to this other neighborhood for a little while or do whatever, unless you happen to have a business there. Okay, so this is how we estimate this stuff. So you also have value of supply, which was Lawrence Berkeley National Labs, I guess. But that was only industrial and commercial customers. Now, it was a USA-based survey, but eventually we chose to use the Lawton Damage Function because it was referenced in a White House report, and it gives us numbers for the residential, industrial, and commercial customers. Now, at an intellectual level, again, like I said, not entirely comfortable with this as a cost function, but I have to build the model even though I don't have the tools yet, which is why I come here and talk to you. Maybe you have some thoughts on this and you can help me out. So we refer to this as the lumpy cost functions. When you're building infrastructure of any kind, you spend a bunch of money, and you spend some more money, and you spend some more money, and you spend some more money, and then suddenly it pays off. It's not like it has this linear value to society. And in fact, macroeconomics has trouble understanding the value of infrastructure to GDP. They can make some sort of sense of it would give us this percentage boost to our GDP, but it's not a very clear science. In fact, it's much like computer science, right? It's only been about 50 years that macroeconomics has been running, right? So we do want to get some sense of time of day mattering, day of the week, season of the year. And this is covered in this particular report that we're using. The point here is just, it's not linear, but for a model, we have to make some assumptions. Oops. OK. So this is the actual Lawton damage function. I was told never to put more than one equation in a set of slides, so I won't make you understand that. But the point is that it's there. You can go and use this to have a fictional outage. You know roughly the number of residential customers, the commercial customers, and the industrial customers, and then durations. Now, does this strike anyone as these numbers might be a little bit scary? In the sense that they're not very high, right? And that's because this is done for surveys. This is not really Catastronomics yet, because it's not recognizing that a very, very long outage would have a much bigger impact on the country's economy than just these nominal dollar amounts, right? So the Risk Center terms that GDP at risk. And by not trying to make it a simple number, it's easier to say we've lost 5% of GDP for the next 5 years, and that's a little bit more meaningful than just having some large number. OK, so a little bit of outages. I know most of the people in this room probably know a lot more about this than I do, but a little bit of data about outages. This is basically what I would call structural outages. These are outages across a 4-year period, right? And it gives you a sense of how frequent they are in different places. So traditional insurance says frequency and severity is the most important thing in the world, and they call these exceedance probability curves, and we're kind of expected to construct them for cyber. We all know this is kind of crazy, but it's how they understand risk. Now, that's why I spend a lot of time with the man-made peril folks, the people who've done war, terrorism, kidnapping, piracy. They understand that their risk frequency severity curves will change rapidly over time because they're dealing with intelligent adversaries, right? So it's not going to stay static like it would for what we call a natural catastrophe, NatCat. OK, so number of outages by duration. I'm not going to focus too much on these slides. Like I say, you can go and get this data yourself. But it gives you a sense that there is some sort of distribution here, and that long outages are not really represented in the literature. Everybody remembers the 2003 outage, right? Yeah? I hope so. Is everyone awake? Does everyone lunch? Everybody wants lunch, right? OK, I'll go fast. 2003 outage, if you had to make a guess from a risk perspective how frequently an event like that would occur, anybody know? Huh?
Say 5 years.
5 years? That was a 1 in 23. So most people would have expected that to be a really, big power outage. But actually, we should expect a power outage of that size once every 23 years, just due to random events, complexity of the system, weather, et cetera, et cetera. So when we're talking about critical infrastructure going down, let's see, let's back up. We need to give numbers to the people who make these sorts of decisions, and they want to know about this frequency and severity, and they want a final cost. Like, it would cost us 10 billion. Like, I think it was 6 to 10 billion that particular outage was estimated to have cost in raw numbers. But we think measuring that in terms of lost GDP as a distribution curve over time that recovers, and there are some assumptions about return to mean that the Oxford economics model uses that we're challenging. But we're working in a completely new field, and we're trying to find our way. So these are outages by disturbance types. Again, the slide is probably a little bit too small to read, but you can see that severe weather is by far the most important thing. Cyber just doesn't even appear on this, as you can imagine, right? It's just not important in this particular data set. But what is the cost of structural outages? Let's get down to the money. If we can take an amount of money to some policymakers, they will start to care. So structural outages, or outages from all other things, cost the US economy about $79 billion. You just absorb that in your fees. That's it. So if we want a cyber attack that wakes them up in any sense at all, it's going to have to be at least one order of magnitude beneath this, right? We're going to need like an $8 billion event before they really care. And we all know that the power utilities are optimized to get people back on supply as quickly as possible, which is a challenge when you're trying to create a cyber event, a fictional one, that has a high cost, right? So this is the problem we're dealing with at layer 8. So I'm living at layer 8 these days, and I'm trying to convince people, maybe even layer 9, to put the money in the bank to be prepared to insure this stuff. And they want to know what their probable maximum loss is. So we could start talking about disrupting power quality instead. We certainly hear a lot about outages, but we don't hear about goods and services being damaged because the power quality is not at the level it should be. And the theory is that you can't model this stuff because of man-made perils. So like I said, one of the advantages of Cambridge is working with businesses that have been around for 325 years. They remember when the sea was not owned by anyone. In fact, various people, there was a papal decree that declared that one half of the world, basically west of this line, belonged to Portugal, and another half belonged to Spain. And pirates were sailing the seas and taking over each other's ships. And they were stealing goods from each other. And basically, companies were the battleground for pirates and nations. And there were sanctioned nation-state pirates called privateers. Does this sound familiar? The sea was a commons. The internet is a commons on which we all do business. We need to secure it. Maybe insurance might be able to help us, even though we find them frustrating. So, cyber risk as an insurable peril. I'm looking into it. I'm not convinced. I'm not convinced they're going to make a big difference to security if they do show up and pay some of the bills. But they could. And that's why I came here to talk to you about it. Can we make sure that if we work with them on insuring not just the power grid, but other things, can we make sure that when they come to visit the companies to offer insurance, they actually demand meaningful changes to the security posture of that organization? A rising tide lifts all boats. That's what we're talking about. Okay. So this is our frequency and severity. Roughly, just a thought model for cyber. We do believe that targeted physical damage, while it is very impactful, usually doesn't affect quite so many companies. In the same way that Microsoft Windows exploit might affect a lot of companies, but the severity of loss is not very high because IT teams are optimized to deal with that. We do think power grid disruption or even, surprisingly, long-term data corruption might cost a lot more money. So that first scenario was there. And it's a very simple event. It's just corrupting some floating point calculations in the Sybil logic bomb. But we reckon that it could have cost the total global economy 4.3 trillion. Okay, so we need to understand the economy of the world online before we even model the costs of these things and convince policymakers to change anything. We also really like to study systemic risk. These guys remember asbestos, and they remember being hit by it and paying out a lot of money, and they don't want to see that again. So they're looking for fire breaks within this total system. They're looking for places where they are not suffering the same risks as they are insuring people for. Now, it's easy with a hurricane. You just build your headquarters in a place that doesn't suffer from hurricanes. But what do? Not use a database as an insurer? Not use an IT system? Not run any code? They're going to be subject to the same risks as all of the rest of us, and then they're going to have to insure us for it. That's a systemic problem, and that's why we're studying it. So this is a graph of the economy, the global trade of Fortune 500. I'll put them up with some names of companies. And this gives you a sense of their relationship, how much money they exchange between each other, and they're broken up into sort of traditional sectors individually. Now, like I say, it's only the Fortune 500, it's not everything, but it gives you a sense of their interrelationship and how they rely on each other. Okay. Is that a little bit better? I saw some people taking pictures, so I'll leave it up for a minute if you want. It's graph porn, like I said. We play with this all day, and you can look at it on our website if you want. But this is how we speak to each other. This is how I talk to people who do, biochemical studies or people who do pandemics. We need to be able to share information in some similar languages. And so we use macroeconomics and network theory. And this is a force-directed graph for those graph geeks in the room. Okay, so we have this idea that there are strategically important technology enterprises. That's not great thinking, but it is true, right? That code is infrastructure for business. And some companies are very, very important. That's all I'm saying. It's not amazing, but it gets across the point to management that some companies are infrastructure for your company, right? Okay. So I won't labor this point. You guys get this. It's not, but it's analogous to something that they've encountered in the insurance industry before, which is the CFIs, strategically important financial institutions. Okay, so in the short term, insurance is coming. The reinsurers are interested. They have very deep pockets, and they're very interested in helping protect the US power grid, the UK power grid, and Europe. They also insure in Asia, and they're happy to do that too. But we need some studies. And we can't talk about critical infrastructure assessments that we've done, so we have to make up a scenario that's big enough that they can study it, that they basically red team their portfolios with this information, right? It does not mean that it has to be perfect technically. It's very boring, in fact, writing these technical details because nobody wants me to pick apart a binary and find a vulnerability. They're terrified of that. That sounds really scary. So they just want me to make up a short science fiction story that's reasonably plausible, plus or minus 10% of what's true now, and then move on to the macroeconomics of everything. So I'm tasked with creating this probable maximal loss imaginary cyber attack. I could do with your help. I'll do the UK next. And the reinsurance industry is particularly interested in getting involved. We want to make sure that if you don't secure things, you don't get insured. In the long term, I think as critical national infrastructure defenders, we need much, much clearer thought. We need to approach some sort of a science of criticality and a science of critical infrastructure. We can measure economic criticality. This is, I think, a key concept to what I'm trying to bring across to you. We can kind of get our heads around geographic criticality. Logical criticality is often lost to us, but maybe one day in the future we'll be able to derive that from the networks that we're trying to protect. I don't want to have to stand around and interview a lot of people to find out about all these dependencies. It just takes too long, right? So can we use other things, such as mathematics, data science, dependency theory, supply chain? The engineer in charge of the risk center is actually an engineer, and he does supply chain risk. But the team is made up of a wide variety of people, including even a historian, which gives us a very, very different perspective. And finally, how do you win a cyber war? Stand back and make money while everybody blows everything up. So that's my presentation.
Okay, so let's get some questions for Eireann. We have one over there. I'll grab a mic.
Tim Yardley, University of Illinois. So insurance and reinsurance is a foreign market to many of the people in this room, but it's something that I've been dabbling in. So I have a question for you, which is reinsurance is a much different game than insurance, especially when it comes to cybersecurity. And the problem with the reinsurance market is that it suffers from the notion that it really can't change what the insurers are insuring. They can, try to influence, but they can't effectively change it. And further, the insurers can't necessarily change what the companies are doing. They can say whether or not you're insurable and whether or not they're willing to insure you and charge you a bigger premium if they're not happy with what you're doing. But how do you see that landscape changing? I mean, it's easy to say, well, that's how it is. And to move towards a science of quantifying it is definitely important because that gives them metrics to then do it. But there's also the game of how can they actually improve those metrics? How can they influence those industries? That is a big question mark, and science doesn't help there.
So I guess to start off with, we're inventing metrics, rough metrics, in a land of no metrics at all, right? And we're going to be wrong, and we know that. The point is that we're wrong and we can refine, and we understand what metrics actually make some sort of a difference. So that hopefully answers the metrics side of the question, but that's the easy part, right? The hard part is exactly what you were describing, this kind of multi-tiered insurance market where the reinsurers don't think they can have any effect on the insurance policies that the others are selling. Well, one of the things they're keen to do is understand whether they're absorbing cyber risk in all of their other policies, right? Have they written an all hazards policy? And they don't want to get caught with that and be selling you policy at the same time. They will change. They will have to change. If you've seen some of the policies written currently, they're terrible. It's like, do you use product Y? Yes. You can have 50 million in insurance cover. That's it, right? An IP reputation product. Do you use IP reputation? You can have 10 million in cover. So the way the insurance companies are going to kill you in that game is they're going to set your loss so low that it's meaningless. And business owners still don't understand their dependency on IT. They might have a 30 million coverage policy, but they're actually exposed to 300 million in risk, And certainly forensics and cleanup costs easily get into that range. And if we're talking about power outages, anyone who's worked a hurricane knows that it's just going to go up, right? So if you don't want to get hit by having the value of your coverage too low, then you're going to have to demonstrate more and more the security of your organization, right? So to get more insurance money, you'll have to crawl up that hill, right? That's the way I see it going. It's not like that at the moment. Right, or pay the premium, right.
Go ahead.
Donovan Tyndall with Honeywell. What are you seeing is going to be the baseline or the minimum requirement that the insurers are going to expect? Like, do you see it come as regulation, or do you see it as the one of 50 standards that we're developing? Like, is that part of the problem? Do we need to get ahead of this problem, or is insurers just going to fill it in for us?
I think, yeah, they'll fill it in for you. But the other thing that they're excited about is, at least the people I'm speaking to, they're very, very bright, and they understand the world. They're scientists, they're risk officers, and they know that there's not a solution for digital insecurity, right? It's certainly not a single solution. So I think what they're looking forward to the market doing is allowing that innovation to occur, and then when it does succeed somewhere, they can replicate it, hopefully. When they see in the actuarial data that this company has a 30-strong team looking after incident response within the company, that's working. Let's make sure that's part of the policy. But instead of waiting in there and going, right, you're going to fulfill this standard, you're going to do this, you're going to do that, they're not going to be prescriptive. They're going to wait for you to innovate and see which strategies are successful and replicate them. I think that's their approach.
Okay.
You sure? He's thinking about it. He thinks he has another one. There's one up front there.
Okay.
Mark Blackmore with Cisco. On the converse side of that, something I'm hearing about too is around liability and the idea of commercial reasonability, I believe. So how do you see, I guess kind of as an add-on to Don's comment, I mean, how do you see this affecting the liability that companies may face if they're not at some, unset standard that their peers are? Do you see that as a knock-on, or how would you look at that?
Yeah, it's one of the things that's scary for me, for you, for companies, for everyone, is that the insurance companies form consortiums of risk, and they might choose to go any way they want, right? So if they see that they're just suffering costs, they might turn around and go, well, it's time for software vendors to have liabilities. And they'll succeed at that if they want, right? They've done this before. So maybe as a vendor, you don't want to see that happen, and you might take some steps early to lift yourself and your security posture to another level. I don't know. I don't know how it's going to play out. I freely admit that. But that is one way that it could go, is software liability in the long run.
So one of the things we saw with like NERC SIP is that a lot of companies that were doing really good security, as soon as the SIP standards passed, dropped their security levels down. They're like, okay, here's the new floor. I'm above the floor, therefore I'm wasting money.
Right, PCI again, right?
Right, PCI again, yes. So with the insurance market, one of the things you're trying to model through some sort of actuarial data and stuff like that is what's my risk, and I look at this over time. But will the mere existence of insurance reduce people's security posture, or would there be do you expect a change, a downward or an upward trend just from there's insurance now, therefore some of this risk is not mine, therefore I can do something different?
I think that's how corporate executives will see it, but they don't really know the insurance industry and its long-term plays, right? So yeah, some people will go, fine, I'll buy insurance and I won't hire a team to defend myself. But I think the insurance industry is going to figure out that's a ploy pretty quick and then adapt. We'll see. I could be wrong. I'm taking a big gamble by joining the center and focusing on this stuff, and maybe I should be picking binaries apart. Maybe some of you are happy that I'm not. But I'm going to take the risk intellectually that this might lead us somewhere, because it might affect the most people at the same time. And I'm particularly interested in the national perspective, right? Because the power grid is run by private companies. Their profits are not very high for the services they deliver and the value they give to our GDP. Government feels like it's responsible, even though it doesn't run those companies, and doesn't have a lot of money to throw into the problem. So we have to figure out that higher level problem of how much we value the uninterruptibility of our infrastructure. And until we can answer that with some equations, we can't really do critical infrastructure protection the way we want to. Yeah.
So Tim Yardley again. I hate to dominate questions, but the point you just made is a very important one that stems from Jason, which is liability. When you look at critical infrastructure, who do you pin the liability to when an outage happens? So if you take out a big utility and that causes a cascading failure, where, from an insurance point of view, who's responsible, who gets the claim, and whose claims come to that, right?
Right.
And then further, you mentioned insurance policies earlier and how horrible they are. Just like normal insurance policies, they have things like acts of God, acts of terrorism, that limit things. So, and that designation is the government has to say that it's a terrorist act.
Right.
But I think with cyber, that's going to change. And what happens when it's, attributed to, say, a nation-state attacker? Is that now something that gets written out of policy? And if so, does it even matter for critical infrastructure anymore?
Can you re-explain just the last bit? Like, why does that not matter to critical infrastructure?
So if the standard, small print in every insurance policy is going to say, this insurance doesn't apply if it's a nation-state attacker, the nation-state attackers are the ones that likely would be going after the control system.
That's a great question, and I guess I haven't thought as much about it as I'd like to. But the reason is because I'm pushing them not to have attribution be a key in the policies. Because I think one of the facts of life we're going to face in the future is attribution is just not going to get done. We're going to have it at the organizational level. I know it was this team of hackers, but we're not going to have it at the kind of nation-state level. We've seen that. We know that, right? We're never going to get the full technical detail or the classified report. It's not going to be proven in public. It's just going to be casting aspersions. So I don't want to see the insurance industry get caught in that, and I'm advising them not to write policy based on that unless they want to abuse you with it, right? But it's a big tool we could be using to help protect ourselves. Get involved, right? I know you are. So that's a good point, though, about whether or not they'll use attribution to dodge giving you the money when something's going wrong. Don't let them write that into your policy, right?
Do we have any other questions? There's one more over there, Liz.
My last question, Donovan Tyndall with Honeywell again, is how are insurance companies, or are they coming up with a framework to, say, have indicators of a strong postured cyber company, kind of in the same fact as we have good drivers and weak drivers, or what indicators do they have that a company is good at cyber and they have a lower premium versus this company which is really bad, therefore let's charge them more? Do they have any clues of what they're going to do there?
Yeah, right now, none. It's an open field. You sometimes see stuff in policy, but it's very rules-based. It's like, do they do this? Does a CISO exist, right? It's kind of at that level. Or do they use product X or Y because some vendor has convinced them that if they use this, everything's fine. So we'll see that for a little while. It'll not be very good for a while. But eventually, they'll catch on to some metrics and share data between each other. And I think one of the other things they might do that you might not expect is buy penetration testing services. So there might be a lot more purchase of pen testers' time from the insurance companies, right? And I think we'll also see a much better forensics market with more people paying for forensics, not to the level of attribution, but to the level of technical understanding of whatever malware they're dealing with. So it's going to change things, and it's going to start off being really, really rough and not useful at all. But they can just sit there for 100 years and gather data until they figure out what does actually work for security. That's their perspective, right? They think very long term.
Great. Well, thank you very much, Eireann.
Thank you.